Yeah.
Canada Goose, iconic name. It's funny. I remember about six and a half years ago, we were looking at Canada Goose and Aritzia and making a recommendation there, and we went with Aritzia. And if you look at the share prices over the past 6 years, we are very happy we went with Aritzia over Canada Goose. But that doesn't mean there can't be an opportunity today. Brennan's going to take a look at it.
Yeah. So Canada Goose Holdings, GOOS on the TSX, trading at a price of about $12.30, about a $557 million market cap. And they design, manufacture, and sell performance luxury apparel for men, women, youth, children, and babies internationally, as well as in Canada, of course. And it offers parkas, light weight down jackets, rainwear, windwear, apparel, fleece, footwear, accessories for fall, winter, and spring seasons. The company has 3 segments: direct to consumer, including sales to customers through direct retail stores and e-commerce; wholesale, selling to other retailers and international distributors; as well as other, including sales from the Paoli Confetti knitwear manufacturing business. I absolutely butchered that. And as of December 29th, 2024, the company had 74 owned stores. And surprisingly to me, the company manufactures all of their products in Canada. I actually didn't know that. So Canada Goose's IPO was in 2017 at a price of about $17 per share. But despite revenue and EPS growth since this time, the stock is trading back down below its IPO price and is down about 50% over the past 5 years and is down 80% from its high in 2022. Now, I came across these 2 Canada Goose ads over the weekend. They're on the right-hand side there for the company's rainwear and light outerwear, as the company is primarily known for its large down jackets. So I thought that it was interesting that the business is trying to market and become more known for its light wear products beyond its heavier parkas. On top of this, in 2021, the company launched its footwear product line, including both boots and shoes. And just in January of 2025, they launched their eyewear collection. So again, you can see the company is looking to increase product innovation to be less of a one-trick pony per se. And I want to show this extreme seasonality here by analyzing the business, by analyzing the operating margin of the company. So you can see that Q3, which runs from October to December, is typically its strongest quarter, and Q1 is significantly weak, consistently running an operating loss. Now, this is one thing that really keeps us somewhat weary of Canada Goose, as if we look at the business like Aritzia, for example, the company has seasonality, but it is far less extreme, and the business continues to operate at a positive operating margin throughout the whole year, as compared to Canada Goose there. Now, looking at the most recent financial results for Q3 of 2025, which ended December 29th, 2024, revenue was about $608 million, a decrease of 0.3%, or on a constant currency basis, decreased by about 2.2%, which reflects the strength of the US dollar and the Chinese yuan relative to the Canadian dollar in the current quarter. Same-store sales in its direct-to-consumer business decreased 6%, which is not good to see. And wholesale revenue was down 8% as the company plans to focus on premium and store locations. Management noted that the weak results show macroeconomic pressures affecting consumer sentiment in North America and EMEA, as well as slower than expected recovery in China. Now, gross margin was up to 74.4% in the quarter due to favorable pricing, lower inventory provisioning, and higher proportion of direct-to-consumer revenue. Meanwhile, it was offset to some degree by continued execution of their outerwear strategy, as their down jackets are typically higher margin. So keep this in mind as the company looks to diversify away from their down jackets. And this is like an actual direct quote from their MD&A. They say, as our product mix evolves, our gross margin has been and may continue to be unfavorably impacted by a lower proportion of down-filled outerwear sales, currently our highest margin products. So keep an eye there. And net income was 139.7 million, an increase of about 7% from the same period last year. And basic earnings per share was $1.44 per share, up about 11% from $1.30. And this was further benefited by the decrease in the number of shares outstanding. Looking at the balance sheet, the company has 285.2 million in cash. Debt and leases were 831.1 million, providing a net debt position of about 546 million, or a trailing net debt to EBITDA multiple of about 1.8 times. But if we do exclude the leases, this would be a little bit closer to 0.7 times the trailing net debt to EBITDA multiple. Looking at the company's fiscal 2025 guidance, management reiterated their total revenue growth of low single-digit increase to a potential low single-digit decrease, but decreased their profitability guidance with adjusted EBIT margin being flat to down 1% and its adjusted EPS growth to the low single-digit increase to flat, with the CFO citing on the conference call that this was due to increased marketing investments and revised DTC or direct to consumer expectations as the contributing factors. On a valuation basis, the company trades at about 16 times trailing earnings, about 5 times trailing cash flow, and about 9 times trailing enterprise value to EBITDA. And this compares to other retailers like Aritzia, which trades with a trailing PE of 45 times, and Nike, which trades at 22 times. I was trying to look up VF Corp, which owns Nike, North Face as well, but they ended up selling Supreme last year, so their results were a little messy, and they actually have a trailing 12-month net loss. So technically, it would be negative. So just looking here, at these comparisons, relatively speaking, Canada Goose is discounted, but it is no surprise given their weaker results, reduction in guidance, and of course, tariff concerns. So to conclude here, Canada Goose is a well-known brand internationally, but is quite seasonal due to its down jackets, which are its primary products. The company appears to be working to diversify away from its primary product of down jackets, introducing new product lines, which over time may hurt margins as down jackets are its higher margin product. The company manufactures 100% of its products in Canada, so tariffs on Canadian goods would impact the business. And just to put it into perspective, in the last quarter, about 25% of their overall sales were coming from the US. So keep that in mind. Now, the Q3 2025 results were weaker, with same-store sales down 6%, although EPS was up. The balance sheet is healthy, and the stock trades at a discount to retail peers, but like I was just saying, is expected given growth and tariff concerns. Now, personally, I would be a customer of Canada Goose's products if I can actually afford them, but would not look to invest in the business. It has a great brand name, but really it just comes down to other names which are more attractive in the space and, I would prefer to own. Plus, I will add their products are very expensive. And personally, if I was going to own a stock in the retail sector, I would not want to invest in a company which is selling such premium goods, especially in, an uncertain macroeconomic environment. Like I was looking on their website, and they're selling joggers or sweatpants essentially for like $600. Where realistically you can get a nice pair of Lulus for $70 or $80 along those lines. So very, very premium products. Again, not a bad business, great brand name, but I don't think that I would be investing at this time. And there's the conclusion or the disclosure.
Yeah, fashion is fickle, and when you tie your name to one brand, I mean, there are some companies that can successfully do it and keep a premium brand over time. If someone says you're out, that is what would worry me about a name like that. So I think the products are high quality products.
Yep.
They're pricey as all hell. But yeah, like I that is what worries me. And one of the things about Aritzia, they don't just sell their own brand; they have a bunch of brands under that name that they can sell through. So you don't tie yourself to just, oh, Aritzia is in or out. They have brands under that name. I mean, it's one of the reasons why we have favored that company over Canada Goose.
Yeah.
The growth is way better too.
Yeah, and like one thing that I'd like to say too
profitability is better
on Aritzia, like looking at the valuation, somebody would be like, well, why the heck were you buying Aritzia at 45 times earnings? Well, it wasn't. We saw the multiple expand, quite drastically, because of the consistent growth. So, I don't recall exactly what it was trading at, when we initially recommended it.
It was about 18 times, in that range, growing way above that.
Exactly. And probably, maybe I'm going out on a limb there, but probably less volatile when it comes to if consumers are hurting in the world. I think that, they're probably going to want to go and buy some, lower priced clothes rather than going and spending, $1,500 on a parka, or again, $600 on a pair of sweatpants, which I could go to Amazon and go and buy some sweatpants for probably $30, which are going to serve its purpose. So yeah, I think that is like one concern is, those higher end products may be more impacted if, the economy does take a little bit of a downturn.
Yeah. And if you just look at adjusted EBITDA in terms of Aritzia was up 48% in the last quarter. Net income was up 71%. Adjusted net income up 57%. So just a completely different level of growth in the businesses on an earnings basis. So really different businesses. All right.
I was just going to say one more thing. They have a big exposure to China as well, which has been macroeconomically weak, and it's kind of that same.
Canada Goose. Yeah,
you have about a third of their sales for Canada Goose are from China, a bit over actually. So if you
weakness
see that economic weakness, which you have in the last few years in China, it's really hurt their growth profile, because it was really seen as that growing, and they have such a focus on luxury brands there that it made a natural sense. But since they've had economic weakness, now are you seeing that going to happen in North America regardless of the tariffs?
Yes. Yeah.
But you've seen the repeat for over half the revenue.
And you have worries on tariffs, but you just have a general economic slowdown as a worry too for a high-end retailer for sure.
Yeah. One last thing too, not to put you on the spot, Ryan. Did you know that 100% of their manufacturing, Canada Goose, was in Canada? I honestly didn't know that.
Yes, I did.
You did know that? Yeah, I didn't know that. Wow.
Yeah. Well, because we looked at it years ago, right? So but we have looked at it. Yeah, it is interesting. You would think that they'd be sourcing it, but it's Canada Goose. So it's
no wonder they're pricing their products so high. Anyways.
Yeah. Well, they can right now.
Yeah.